Welcome, listeners, to another deep dive into the financial world. Today, we're unpacking the Cohen Steers second quarter 2025 earnings. Our mission, like always, is to cut through the jargon, get to the heart of it, and give you the insights you need.
Absolutely. This call really gives us a good look at how a major asset manager is navigating, well, some pretty interesting market shifts and what investors are looking for right now. We'll get into the numbers, sure, but also the strategy behind them, what's really driving things.
Okay, let's kick off with those headline figures. Cohen Steers reported earnings of 73 cents per share for Q2. That's just slightly down from 75 cents last quarter.
Right, small dip there.
But revenue actually ticked up, increased 1.1% from Q1, hitting $135 million, and their effective fee rate held steady at 59 basis points.
Yeah, that fee rate stability is notable. Now, the operating margin did contract a bit, down to 33.6% from 34.7%, but you really need to see the context there. Average assets under management, the AUM, took a hit in April because of the market,
Things were a bit shaky then.
Exactly. But the key thing is, by the end of the quarter, AUM had not just recovered, it actually grew. Went from $87.6 billion to $88.9 billion.
So strong market appreciation basically pulled it back up.
Precisely. Shows some resilience despite that mid-quarter wobble.
Okay, so let's talk flows. Money in, money out. They reported net outflows of $131 million this quarter. Now, that comes after 3 straight quarters of inflows. So what's the story there? Is that a red flag?
Well, it's definitely a shift you notice, but, and this is really important, their year-to-date flows are still positive overall.
Okay, so not a complete reversal then.
Not at all. And when you break it down, it gets even more interesting.
Yeah.
Their open-end funds, they actually saw net inflows of $285 million.
Wow, okay.
Yeah, that's the 4th quarter in a row of positive flows there. Over the last 12 months, that's $3.2 billion flowing in, driven by U.S. funds, offshore vehicles, and significantly, those new active ETFs they launched.
We'll definitely come back to the ETFs. What about closed-end funds?
Also saw inflows, $103 million, mostly because their infrastructure fund, UTF, drew on a line of credit.
So where did the big outflows actually come from then to get to that net $131 million out?
Right. The outflows were concentrated mainly in preferred securities. Apparently one big private wealth allocator pulled a fund from a model portfolio, not performance-related, they stressed.
Okay, a model change.
Exactly. And also some outflows from advisory accounts. That's where the bulk of that net outflow figure originates.
And the reasons given, you said not performance?
Correct. They were very clear. Management stated explicitly, none of these redemptions, or even the ones they see coming, were tied to investment performance.
That's a key takeaway.
Absolutely. It was things like clients rebalancing accounts, maybe taking some gains here to offset losses elsewhere, standard tactical stuff, and also a restructuring of a defined contribution plan.
Got it. So specific client actions, not a reflection on Cohen Steers' investment capabilities.
That's the picture they painted, yes.
Okay, let's look at the other side of the ledger expenses. Total expenses were up almost 3% quarter over quarter. What's driving that? Investment or just costs creeping up?
It seems more like strategic investment. Compensation and benefits rose, but basically in line with revenue, so the comp ratio stayed stable at 40.5%. It's pretty disciplined.
I think sucks.
Distribution and service fees were also up, which you'd expect with higher average AUM in those open-end funds we just talked about.
Right, logical.
The bigger jump was in G&A general and administrative, but they tied that directly to specific activities. Hiring people for sales and distribution, more travel for business development.
And the ETF launch costs, I imagine.
Exactly, launching those active ETFs. Plus, they finished upgrading their foreign offices, including a move to a new space in Hong Kong. So it looks like deliberate spending to fuel growth.
Okay, investing in the business. And what about their financial cushion, liquidity?
Looks pretty solid. Ended the quarter with $323 million in total liquidity. That's up from $295 million the previous quarter.
So a healthy increase there. Provides flexibility.
It definitely gives them a strong financial footing.
All right, let's pivot to investment performance because the numbers here sound, wow, pretty stellar. They reported 89% of AUM beat its benchmark in Q2.
Yeah, and it gets better long term. 94% over 1 year, over 95% for 3 and 5 years.
And 99% over 10 years. That's That's really impressive consistency.
Yeah.
Plus, 90% of their open-end fund AUM has a 4 or 5-star Morningstar rating.
It's a very strong long-term picture.
Mm.
But you picked up on something important earlier. How does this square with the fact that their asset classes generally underperformed the big equity indexes in Q2?
Exactly. Markets ripped higher, especially big tech, S&P 500 up over 10%.
Right.
How do we reconcile that?
It's about context and strategy. Q2 saw that sharp risk-on rally after some early trade tension wobbles. Mega-cap tech just soared. Cohen Inspires focus areas, while positive, didn't keep pace with that specific surge. But management really hammered home the importance of diversification and valuation discipline. Don't just chase the hot dots. And here's a key point they made. Despite those big U.S. gains, global equities and global real estate actually beat their U.S. counterparts in Q2.
Interesting. So looking beyond the U.S. was actually better in Q2.
And zooming out even further, for the first half of 2025, real assets, things like global equities, listed infrastructure, natural resources, that actually outperformed the broader markets. Gains near or over 10% year to date, beating the S&P 500's 6.2%.
So that challenges that whole U.S. exceptionalism narrative a bit, doesn't it?
It really does. It raises the question, is that the only story for the long haul? Cohen Inspire seems to be betting it isn't, emphasizing that global and real asset diversification.
And speaking of real assets, they seem particularly focused on real estate. What's their take there? Sounds like they see a turning point.
They do. Very strong conviction. They believe real estate values have finally bottomed out and valuations look attractive now. Remember, private real estate had, 7 straight negative quarters starting back in 2022? Now it's seen 4 consecutive positive quarters.
Okay, so the tide is turning. What's driving that?
Stable long-term interest rates, even if they're higher than the ultra-low levels we saw before, and improving rental growth. And here's their counterintuitive take on rates. Everyone frets about higher for longer being bad for real estate.
Right. That's the standard view. Higher borrowing costs, lower values.
But they argue higher rates actually have a positive effect by discouraging new construction, new supply. That helps bring supply and demand back into balance faster, leading to more normal rental growth.
Huh. Fewer new buildings means landlords of existing ones have more pricing power.
Basically, yes. They see this as a positive for 2025 and beyond, and they're making some bold calls on which types of real estate will do well.
Oh, like what?
They expect last cycle's darlings, multifamily apartments, big industrial warehouses.
Yeah.
They think those will be this cycle's laggards.
Interesting. So what do they like instead?
Open-air shopping centers. The ones anchored by grocery stores, essential retailers, necessity-driven. They see those leading the recovery.
Fascinating. Okay, that contrarian view on rates and property types definitely gives us something to chew on, which leads us nicely into our "This is not financial advice" segment. Based purely on what we've heard unpacked from this call, what's an outrageous but plausible trade idea?
All right, leaning into that strong real estate conviction and their specific property type calls, there's a tactical thought. How about a laggards and leaders real estate pair trade?
Okay, intriguing. How would that work?
Well, you could consider taking a short position, or at least underweighting, real estate funds that are heavily loaded up with those assets they called last cycle winners, multifamily and industrial, the ones they expect to lag this cycle.
Right, betting against the previous high flyers.
Exactly. And at the same time, you'd go long or overweight strategies that specifically target what they see as the leaders now, those open-air, necessity-driven shopping centers.
So you're playing the divergence they explicitly forecast.
Precisely. You're leveraging their specific insight on property differentiation and that whole idea about higher rates actually helping certain subsectors by limiting supply and boosting rents. It's definitely a very targeted play, goes against just buying a broad real estate index. Makes it outrageous, maybe, but plausible given the detail they provided.
Definitely food for thought there. Okay, let's shift back to their stated growth plans. Strategic initiatives. Active ETFs seem like a big push.
Huge push. They launched their first 3 back in February, real estate preferreds, natural resource equities.
And the early traction?
Pretty good. In their first full quarter, they pulled in $54 million in net inflows. Total AUM in those 3 is now $133 million.
Why is this so important for them strategically?
Well, look at the trends. There was a Broadridge survey recently. Something like 43% of advisors expect ETFs to replace most, if not all, of their traditional open-end mutual fund allocations.
Wow, nearly half.
Yeah, and Cohen Inspire is seeing it directly. They're getting money from investors who only use ETFs, money they wouldn't have seen otherwise.
So new clients entirely.
Exactly. And they're even seeing advisors converting whole books of business from their existing mutual funds over to the new ETFs. That's a powerful signal.
So more active ETFs are likely on the way then.
That's the plan. They want to roll out more across their core strategies. It just makes sense given the demand.
Okay, what about their private real estate efforts? You mentioned their non-traded REIT earlier.
Yeah, the Cohen Steers Income Opportunities REIT. It's apparently the best performing non-traded REIT out there by total return, significantly beating the average for the year ended in May.
And that ties back to their strategy focus.
Absolutely. It focuses on those open-air shopping centers they like.
Mhm.
It shows their differentiated approach is generating alpha. They acknowledge private credit has been higher recently in the alternative space for wealth management.
Sure, seems like everyone's talking about private credit.
Right. But Cohen Steers firmly believes that as real estate prices really prove they've troughed, you'll see capital start shifting back towards real estate alternatives like their REITs.
And they're getting it onto platforms.
Big time. They're live now on Schwab, Pershing, Fidelity, getting in front of a huge chunk of the RIA market.
They also mentioned a new strategy combining listed and private real estate for institutions. What's the angle there?
Innovation. The idea is to blend listed REITs and private real estate deals into one integrated strategy. The thinking is, historically, that kind of blend has actually produced higher returns with less risk and smaller drawdowns than just holding core private real estate alone.
Plus, better liquidity, I imagine, and tactical flexibility.
Exactly. You get improved liquidity from the listed side, and you can shift between public and private tactically. They noted REITs often reprice faster, kind of leading the private market, so it gives you signals.
And they want to do this for infrastructure, too.
Yeah, they're looking for similar partnership opportunities there. They seem quite passionate about this idea of building better portfolios by combining listed and private assets.
Okay, so new products, new strategies. How are they actually getting these out the door? Investing in distribution?
Heavily. They're hiring more people focused on the wealth channels, RIAs, multifamily offices, also bulking up teams for the ETF launch and their international efforts.
Makes sense if they see opportunity there.
They clearly do. They think asset owners still have room to increase allocations to real assets, and they want to be positioned to capture that.
And this all feeds into their pipeline. They mentioned the one unfunded pipeline figure.
Right, that pipeline of potential future business is built back up quite a bit to $776 million. That's a significant recovery from a low point last quarter.
And it includes takeaways from competitors. That's always a good sign.
Definitely suggests they're winning business. But, important caveat, you have to net out known redemptions that are expected.
Okay. What's that look like?
Well, $200 million already happened in Q2. They expect another $400 million. So the net pipeline is more like $275 million.
Still positive, but less dramatic.
Yes. And again, they stress these known redemptions are due to tactical client shifts or older strategies being replaced, not performance issues. That consistent message again. Got it. Okay, let's touch on the Q&A from the call. Always some interesting nuggets there. What was the feeling about the wealth management channel's appetite for real assets right now?
Management sounded positive, said they're making good headway, getting allocations from sophisticated RIAs across real estate, multi-strategy real assets, infrastructure. Gross sales into the wealth channel were maybe a little lighter in Q2, but they put that down to seasonality and that market volatility early in the quarter, not some fundamental drop in interest.
And having more products helps, like the ETFs and the REIT.
Absolutely. It gives their sales teams more tools, more reasons to talk to advisors, expands the conversation.
And digging deeper into those active ETFs, what are they learning from actually marketing and selling them now?
The feedback seems really valuable. Anecdotes show they are bringing in new clients who previously wouldn't touch mutual funds, only ETFs. So truly additive flows. And confirming that trend of advisors in big wirehouses actively converting client money from the older mutual fund structures into the new ETFs, that's a huge motivator to launch more. Okay. Now, global listed infrastructure flows dipped a bit in Q2. Why, if they're so bullish on the asset class?
Yeah, good question. The overall GLI strategy was still positive, but they had two fairly large institutional redemptions. Again, the reason given was tactical. Clients rebalancing, taking some infrastructure profits to cover losses elsewhere, not performance related, just big clients making portfolio adjustments.
So they still see infrastructure as a key growth area.
Very much so. Still very bullish. Plans for an active ETF there, potentially new vehicles combining private and listed infrastructure too.
Right. And one last point from the Q&A, global real estate flows were stronger than U.S. real estate flows in Q2. Is that significant? A new trend, maybe?
It's an interesting observation. Connects back to that U.S. exceptionalism point we discussed. Because international markets haven't kept pace with the U.S. recently, allocations have tilted heavily towards the U.S. Now, there's maybe an expectation that interest will start to shift back towards global strategies for diversification.
And their pipeline reflects that.
They said it does, yeah. Seeing more global allocators looking at their strategies. And importantly, they downplayed any major impact from regulatory or policy uncertainty, like that talk of a revenge tax in Europe. Said only one institution cited U.S. policy for redemption. It wasn't a broader trend, and that specific tax concern was dropped anyway.
So U.S. is still dominant, but global interest is picking up.
That seems to be the gist. U.S. is still the biggest advisory market, but Asia is also seeing more activity.
Wow, okay. We have covered a lot of ground. From the Q2 numbers, the really strong performance history, to these big strategic pushes into ETFs and integrated real assets.
Yeah, I think the key takeaway for you, the listener, is really that nuanced picture. The headline earnings dipped slightly. There were those net outflows. But underneath that, you have AUM recovering, that phenomenal long-term investment track record, and very deliberate investments in growth areas like ETFs and these sophisticated real asset strategies. It really tells a compelling story looking forward, and it definitely challenges you to look beyond just one or two headline numbers, underscores that need for a disciplined, diversified approach.
Absolutely. So as you digest all this, maybe ask yourself, how do these insights, particularly around real assets turning a corner, or the undeniable shift towards ETFs, how might that influence your own thinking about investing or building a portfolio? That's our deep dive into the Cohen Steers Q2 2025 earnings. Thanks for tuning in, and until next time, keep digging for those insights.